if you had to choose between getting paid every 3 months or waiting a few years to maybe hit it big, what would you choose? That's the real-life decision investors make every day between dividend stocks and growth stocks. One gives you steady cash flow, the other chases explosive growth. But here's the twist. The right mix could build real wealth faster than you think. Stick around because by the end of this video, you'll know exactly which one fits you, and I'll give you real examples of each, from Coca-Cola to Nvidia. Let's start with the calm, reliable one, dividend stocks. These are companies that share their profits with you regularly. Every quarter, you get paid just for holding their stock. That's right, money while you sleep. They're usually big, stable, and established businesses that don't need to reinvest every penny to grow. Examples: Coca-Cola, KO. It's paid dividends for over 60 years straight. Procter & Gamble, PG. Maker of Tide, Gillette, Pampers, all boring products but consistently profitable. Johnson & Johnson, slow and steady yet dependable. These companies are like that friend who never cancels plans. Not the flashiest, but always there when you need them. Investors love dividend stocks for income stability. Even when markets crash, that dividend check still arrives. So if you want to build passive income or prepare for financial freedom, dividend stocks are your safety net. Now, on the other side, we have growth stocks. They don't pay you cash now because they're busy reinvesting every dollar to grow faster. Think of it like a startup phase. Less profit today, massive potential tomorrow. Examples: Amazon. It went decades without paying a dividend, but grew from a bookstore to a trillion-dollar empire. Tesla. No dividends, just pure innovation and volatility. Nvidia, the poster child of growth. Investors who held on saw insane returns thanks to the AI boom. Growth stocks are like planting a tiny seed. You don't eat the fruit now, you let it grow into a forest later. But there's a catch. They can be wildly volatile. Prices can skyrocket one month and dip the next. Still, for long-term investors, that risk often comes with huge rewards. Let's settle this once and for all. Here's the quick comparison. Category: dividend stocks, growth stocks. Pays you cash? Yes, regularly. Usually no. Focus: income and stability, expansion and innovation. Volatility: low, high. Risk level: lower, higher. Examples: Coca-Cola, J&J, P&G, Tesla, Amazon, Nvidia. Dividend stocks are like the turtle, slow and steady. Growth stocks are the rabbit, fast and risky. Both can win the race depending on how you play it. So which one should you invest in? If you want regular income or you're close to retirement, dividend stocks make sense. They pay you to hold them, and that steady cash flow can even be reinvested to buy more shares. But if you're younger, can handle risk, and want to maximize long-term gains, growth stocks could supercharge your portfolio. Pro tip: the smartest investors don't choose, they combine both. Use dividend stocks as your foundation and growth stocks as your acceleration engine. That's how you get the best of both worlds: income and growth. So the question isn't which one is better, it's what kind of investor do you want to be? A tree that gives you fruit every few months, or a seed that could one day grow into an entire forest? Plant today, because the sooner you start, the faster you grow. If this helped you understand investing a little bit better, tap that like button, subscribe, and tell me in the comments. Are you team dividend or team growth?